Question 1. What is the primary difference between a fixed annuity and a variable annuity? A. Fixed annuities offer a guaranteed payout while variable annuities depend on market performance. B. Fixed annuities are always tax deferred while variable annuities are not. C. Fixed annuities offer investment options whereas variable annuities do not. D. Variable annuities provide lump sum payments while fixed annuities only allow periodic payments. Answer: A. Fixed annuities offer a guaranteed payout while variable annuities depend on market performance. Explanation: the key difference lies in how the returns are structured. Fixed annuities provide a guaranteed payout based on a set interest rate, ensuring stability and predictability for the annuitant. On the other hand, variable annuities offer returns based on the performance of underlying investments, such as mutual funds, meaning the payout can fluctuate depending on market conditions. This presents a higher risk and potential for greater returns in a variable annuity, whereas fixed annuities are safer but with a limited return potential. Question 2. Scenario: Mr. Brown is 65 years old and wants to purchase an annuity to ensure he has a steady income stream during retirement. His primary concern is minimizing risk. He is considering a fixed annuity and a variable annuity. Based on his situation, which of the following is the most suitable option for him? A. A variable annuity with a high-risk investment portfolio. B. A fixed annuity with guaranteed interest rates. C. A deferred annuity with a long surrender charge period. D. An immediate annuity with flexible payout options. Answer: B. A fixed annuity with guaranteed interest rates. Explanation: Mr. Brown, being 65 and seeking a steady income with minimal risk, would benefit most from a fixed annuity with guaranteed interest rates. Fixed annuities are designed to provide predictable, stable payouts, which is ideal for someone concerned with minimizing financial risk during retirement. The guaranteed interest rate ensures he knows exactly how much income he will receive, regardless of market fluctuations. In contrast, the variable annuity, option A, would expose him to market risks, which may not align with his preference for stability. A deferred annuity, option C, could delay payments, which is not suitable for someone looking for immediate retirement income. An immediate annuity with flexible payout options, option D, could be an option, but flexibility is less crucial for someone seeking guaranteed, stable payouts. Question 3. What is the tax implication when a qualified annuity, G. IRA annuity, makes a distribution to the annuitant? A. The distribution is tax-free because the contributions were made with pre-tax income. B. The distribution is taxed as ordinary income because the contributions were tax-deferred. C. The distribution is subject to capital gains tax due to the tax-deferred growth. D. The distribution is subject to a 10% penalty, but only for distributions made before age 591 were. Answer: B. The distribution is taxed as ordinary income because the contributions were tax-deferred. Explanation: in a qualified annuity, such as an IRA annuity, the contributions are made with pre-tax dollars and the growth of the annuity is tax-deferred. This means that when the annuitant takes distributions, the entire amount, principal and earnings, is subject to taxation as ordinary income at the individual's applicable tax rate. This is in contrast to other tax-deferred accounts where withdrawals are taxed only on the earnings portion. The 10% penalty, option D, applies to early withdrawals from tax-qualified accounts before age 591, but it is separate from the income tax treatment of the distribution. Question 4. Which of the following statements best describes the key characteristic of an equity-indexed annuity? A. It offers a fixed interest rate, which is tied to a specific bond index. B. It guarantees a minimum return, but allows for additional returns based on a stock market index. C. It is primarily a variable annuity that invests in mutual funds. D. It provides payouts linked directly to the stock market's daily movements. Answer: B. It guarantees a minimum return, but allows for additional returns based on a stock market index. Explanation: equity-indexed annuities, IAs, are a type of fixed annuity that offer a guaranteed minimum return while also providing the potential for higher returns linked to the performance of a stock market index, such as the S&P 500. The key feature is the combination of guaranteed returns and potential for additional returns based on market performance without direct exposure to the stock market's daily fluctuations, unlike variable annuities. Option A is incorrect as IAs do not rely on bond indexes, and option C incorrectly describes IAs as variable annuities. Option D is incorrect because IAs are not directly tied to daily stock market movements but are instead tied to index performance over a period of time. Question 5. What is the primary purpose of the free look period in an annuity contract? A. It allows the policyholder to review the policy and receive a full refund of the premium if they change their mind. B. It grants the policyholder the right to make changes to the beneficiary designations without penalty. C. It provides the annuitant with a period of guaranteed returns before finalizing the contract. D. It allows the contract owner to cancel the annuity for a full refund of the premiums if the annuity has not yet been paid out. Answer A. It allows the policyholder to review the policy and receive a full refund of the premium if they change their mind. Explanation: the free look period is a consumer protection feature of annuity contracts that allows the policyholder a specified time, usually 30 days after purchasing the contract, to review the terms and conditions. If the policyholder is dissatisfied for any reason, they can cancel the contract during this period and receive a full refund of the premiums paid. This ensures that the buyer fully understands the terms of the annuity before committing long-term. Options B and C describe features that are not part of the free look period, and option D is incorrect because the refund is only available during the free look period before payouts begin. Question 6. Scenario: Ms. Smith, age 58, is considering purchasing a non-qualified annuity. She plans to use it for retirement income starting at age 62. However, she is concerned about the tax implications if she withdraws from the annuity before reaching age 591. What should Ms. Smith be aware of in this situation? A. She will face a 10% early withdrawal penalty only on the interest portion of the distribution. B. She can withdraw from the annuity at any time without penalty due to her age. C. She will face a 10% early withdrawal penalty on the entire withdrawal amount, including both principal and interest. D. There is no penalty for withdrawals from non-qualified annuities regardless of her age. Answer A. She will face a 10% early withdrawal penalty only on the interest portion of the distribution. Explanation: for a non-qualified annuity, early withdrawal penalties apply only to the interest portion of the distribution before the annuitant reaches age 591. The principal, which was paid with after-tax dollars, is not subject to the 10% penalty. However, any earnings interest on the principal is subject to the penalty. This ensures that individuals do not access their investments' growth prematurely. Option B is incorrect because she would be penalized for withdrawing early. Option C is incorrect because only the earnings portion is penalized. Option D is incorrect because non-qualified annuities do face early withdrawal penalties. Question 7. Which of the following is a benefit of a joint and survivor annuity? A. It provides a higher monthly payout if both annuitants are alive at the time of the payout. B. It guarantees that the surviving spouse will continue to receive payments after the primary annuitant passes away. C. It offers a lump sum payment to both annuitants at the time of purchase. D. It allows for increased payments after the primary annuitant's death based on market performance. Answer B. It guarantees that the surviving spouse will continue to receive payments after the primary annuitant passes away. Explanation: a joint and survivor annuity is designed to provide income to two annuitants, typically spouses. The primary benefit is that after the first annuitant passes away, the surviving spouse will continue to receive periodic payments, usually at a reduced rate. This ensures ongoing financial support for the surviving spouse. Option A is incorrect because the payouts are typically lower than a single life annuity to account for the guarantee of continued payments. Option C describes a lump sum payment, which is not a feature of a joint and survivor annuity. Option D refers to variable annuities, which are linked to market performance, but a joint and survivor annuity typically has fixed payments. Question 8. Which of the following is a characteristic of an immediate annuity? A. Payments begin immediately after the contract is purchased and are typically made on a monthly basis. B. Payments begin after deferment period and continue for a fixed period of time. C. It allows the annuitant to access lump sum payouts at any time during the contract term. D. It guarantees higher payouts than a deferred annuity over the long term. Answer A. Payments begin immediately after the contract is purchased and are typically made on a monthly basis. Explanation: an immediate annuity is designed to provide payouts immediately after the contract is purchased, typically starting within 1 month. This is suitable for individuals seeking a steady stream of income without delay, often used for retirement income. Option B describes a deferred annuity where payouts are postponed until a later date. Option C is incorrect because immediate annuities do not allow for lump sum withdrawals or they are designed for periodic payments. Option D is not accurate because immediate annuities do not guarantee higher payouts than deferred annuities, as the amount of payout is based on the terms of the contract and the time until payouts begin. Question 9. What is a potential risk associated with purchasing a variable annuity? A. The annuitant will not receive any income until the annuity has matured. B. The investment performance of the underlying portfolio may lead to unpredictable payouts. C. The annuity may not offer any guaranteed income options. D. The interest rate is fixed and will not change for the duration of the annuity. Answer: B. The investment performance of the underlying portfolio may lead to unpredictable payouts. Explanation: the primary risk associated with variable annuities is that the payouts depend on the performance of the underlying investment portfolio, which can include stocks, bonds, and other securities. If the investments perform poorly, the annuitant's payouts may be significantly reduced, leading to unpredictability in income. This is in contrast to fixed annuities, where the payouts are guaranteed regardless of market performance. Option A is incorrect because payouts typically begin soon after the purchase of a variable annuity. Option C is incorrect because most variable annuities offer death benefit and sometimes other guarantees. Option D describes a fixed annuity, not a variable annuity. Question 10. Which of the following is true about a fixed annuity? A. The payout amount is dependent on the performance of a stock market index. B. The interest rate is guaranteed and fixed for a specified period. C. The annuitant has the flexibility to choose between various investment options. D. The annuity value fluctuates based on the performance of the annuity's underlying investments. Answer: B. The interest rate is guaranteed and fixed for a specified period. Explanation: a fixed annuity offers a guaranteed interest rate for a specific period, ensuring that the annuitant receives a fixed payout amount during the payout phase. This makes it a stable, predictable investment option. Option A refers to equity-indexed annuities or variable annuities, which are tied to market performance. Options C and D are characteristics of variable annuities, where the annuitant can choose from various investment options and experience market-driven fluctuations in value. Question 11. What is the primary disadvantage of purchasing a variable annuity? A. The annuitant faces a fixed payout regardless of the market's performance. B. The annuity's payouts are subject to the performance of underlying investments. C. There is no death benefit included with the annuity. D. The annuity may require a lump sum payment at the time of purchase. Answer: B. The annuity's payouts are subject to the performance of underlying investments. Explanation: in a variable annuity, the payout amounts depend on the performance of the underlying investments, which typically include stocks, bonds, and mutual funds. This exposes the annuitant to market risk, meaning that poor market performance could lead to lower payouts. Option A is incorrect because variable annuities do not guarantee fixed payouts. Option C is incorrect because many variable annuities do include a death benefit. Option D is not necessarily true, as variable annuities can also be purchased with periodic payments, not just lump sums. Question 12. Scenario: John is 60 years old and has decided to purchase an annuity that will begin payouts in 10 years. At age 70, he wants to ensure his annuity provides stable payouts based on a fixed interest rate. Which type of annuity would best meet his needs? A. A deferred fixed annuity. B. A variable annuity. C. An immediate fixed annuity. D. An equity-indexed annuity. Answer: A. A deferred fixed annuity. Explanation: a deferred fixed annuity is an excellent choice for John because it will begin payouts at a future date, age 70, and guarantees a fixed interest rate for the duration of the accumulation phase, ensuring stable, predictable payouts. Option B is incorrect because a variable annuity depends on market performance and may result in unpredictable payouts. Option C is incorrect because an immediate fixed annuity starts payouts immediately, not in the future. Option D is not appropriate because an equity-indexed annuity ties payouts to the stock market's performance, which may not meet John's desire for stability. Question 13. What is a key characteristic of an annuity's accumulation phase? A. It is the period during which the annuity generates payouts. B. It is the period during which the annuitant makes premium payments and the value of the annuity grows. C. It is the period when the annuitant begins receiving income. D. It is the period when the annuity pays dividends to the policyholder. Answer: B. It is the period during which the annuitant makes premium payments and the value of the annuity grows. Explanation: The accumulation phase is the time during which the annuitant pays premiums, either as a lump sum or through periodic payments. The annuity's value increases during this period, either at a fixed rate in the case of fixed annuities or based on the performance of investments in variable annuities. This phase ends when the annuitant begins receiving payouts in the distribution phase. Option A describes the distribution phase, not the accumulation phase. Option C describes the start of the payout period, and option D is irrelevant to annuities. Question 14. Which of the following best describes a life with period certain annuity? A. It guarantees payments for a specified period or for as long as the annuitant lives, whichever is longer. B. It guarantees payments for a specific number of years and stops upon the annuitant's death. C. It guarantees a specific payout amount until the annuitant reaches a certain age. D. It guarantees the annuitant's heirs will continue to receive payouts after death. Answer A. It guarantees payments for a specified period or for as long as the annuitant lives, whichever is longer. Explanation. A life with period certain annuity guarantees payments for either a specified period or for the annuitant's entire life, whichever is longer. If the annuitant dies before the specified period ends, payments will continue to the beneficiary for the remainder of the period. This provides both a lifetime income and a beneficiary guarantee. Option B describes a period certain annuity, which only provides payments for a fixed period, regardless of whether the annuitant lives or dies during that time. Option C is incorrect because it does not describe a typical feature of this type of annuity. Option D refers to a death benefit, but this is not the defining feature of a life with period certain annuity. Question 15. Which of the following is a feature of a guaranteed minimum withdrawal benefit? Divide A. It guarantees the annuitant will receive a minimum amount of income regardless of market performance. B. It allows the annuitant to withdraw an unlimited amount at any time without penalty. C. It guarantees the annuitant will never lose money on the principal invested. D. It guarantees that annuity payments will increase in value each year. Answer A. It guarantees the annuitant will receive a minimum amount of income regardless of market performance. Explanation. A guaranteed minimum withdrawal benefit ensures that the annuitant can withdraw a minimum amount each year regardless of how the underlying investments perform. This benefit provides income security even if the account value declines due to poor market performance. Option B is incorrect because withdrawals are generally subject to limits, not unlimited access. Option C is not accurate because GMWBs do not guarantee the principal remains intact but focus on ensuring a minimum withdrawal amount. Option D is incorrect as GMWBs do not guarantee increasing payouts over time. Question 16. What is the primary difference between a single premium immediate annuity (SPIA) and a single premium deferred annuity (SPDA)? A. SPIs provide immediate payouts, while SPDs defer payouts to a future date. B. SPIs require periodic payments, while SPDs require a lump sum premium. C. SPIs provide variable payouts, while SPDs provide fixed payouts. D. SPIs are only available to those over the age of 65, while SPDs are available to all ages. Answer A. SPIs provide immediate payouts, while SPDs defer payouts to a future date. Explanation. A single premium immediate annuity (SPIA) starts providing immediate payouts once the premium is paid. This makes it ideal for individuals who need immediate income. A single premium deferred annuity (SPDA) requires a lump sum payment but delays payouts until a future date, often used for retirement planning. Option B is incorrect because both types of annuities can be purchased with either lump sum or periodic payments, but the key difference is when payouts begin. Option C is incorrect because both SPIs and SPDs can offer either fixed or variable payouts. Option D is incorrect as there are no age restrictions for either type of annuity. Question 17. What is the main advantage of a tax-deferred annuity? A. It provides immediate income to the annuitant at the time of purchase. B. It allows the annuitant to delay paying taxes on investment gains until withdrawals are made. C. It guarantees a higher rate of return than other investment options. D. It allows the annuitant to avoid paying taxes on premiums paid. Answer B. It allows the annuitant to delay paying taxes on investment gains until withdrawals are made. Explanation. A tax-deferred annuity allows the investment gains to grow without being taxed until withdrawals are made. This deferral of taxes allows for compounding growth over time. Option A describes an immediate annuity but not the tax-deferred aspect. Option C is incorrect because tax-deferred annuities do not inherently offer higher returns. The returns depend on the type of annuity, fixed, variable, etc. Question 18. Which of the following is true about a longevity annuity? A. It guarantees income for a specified number of years. B. It provides income for the annuitant's lifetime, starting immediately after purchase. C. It is designed to provide income starting at a future age, typically 80 or 85. D. It guarantees a lump sum payout to beneficiaries if the annuitant dies early. Answer C. It is designed to provide income starting at a future age, typically 80 or 85. Explanation. A longevity annuity is designed to provide income starting at an advanced age, such as 80 or 85, helping to mitigate the risk of outliving savings. This type of annuity is often used as a long-term retirement strategy, ensuring that the annuitant has income later in life. Option A is incorrect because a longevity annuity does not guarantee a payout for a specified number of years. Rather, it guarantees income for life, starting at an older age. Option B describes an immediate annuity, which starts payouts immediately. Option D is not correct because longevity annuities do not provide a death benefit like some other types of annuities. Question 19. What is the primary purpose of an annuity rider? A. To offer additional investment options within the annuity contract. B. To provide additional benefits or features that can be added to an annuity for an extra cost. C. To limit the amount of income an annuitant can withdraw each year. D. To convert a fixed annuity into a variable annuity. Answer B. To provide additional benefits or features that can be added to an annuity for an extra cost. Explanation. An annuity rider is an optional provision that can be added to an annuity contract to provide additional benefits or features, such as a death benefit, income guarantees, or long-term care benefits, typically for an extra cost. Option A is incorrect because riders do not offer investment options if they modify the terms of the contract. Option C is not correct as riders generally do not limit income but may provide guarantees. Option D is inaccurate as riders do not change the type of annuity, they enhance the existing contract. Question 20. Which of the following is true about a joint and survivor annuity? A. It provides income for the annuitant's lifetime but stops upon the annuitant's death. B. It provides income for the lives of two individuals with payments continuing until both individuals have passed away. C. It provides a lump sum payment upon the first death, then terminates. D. It is a type of variable annuity with fluctuating payouts based on market performance. Answer B. It provides income for the lives of two individuals, with payments continuing until both individuals have passed away. Explanation. The joint and survivor annuity is designed to provide income for two individuals, typically a married couple. The annuity continues to make payments until both individuals have passed away. Often, the surviving spouse continues to receive payments either in the same amount or a reduced amount. Option A describes a single life annuity, which stops upon the annuitant's death. Option C is incorrect because joint and survivor annuities do not pay a lump sum but instead continue payments until both individuals are deceased. Option D is unrelated to the type of annuity described. Question 21. What does the free look period of an annuity refer to? A. The time period during which the annuitant can receive a lump sum payout. B. The time period during which the annuitant can cancel the annuity contract without penalty. C. The period during which the annuitant can switch from a fixed to variable annuity. D. The time period during which the annuity's rate of return is guaranteed to be above market averages. Answer B. The time period during which the annuitant can cancel the annuity contract without penalty. Explanation. The free look period allows the annuitant to review the annuity contract and cancel it without penalty within a specified time frame, usually 10 to 30 days after purchase. If the annuitant changes their mind, they can receive a full refund of premiums paid, providing a chance to reconsider the investment. Option A is incorrect because the free look period is not about receiving a lump sum payout. Option C is unrelated as the free look period does not involve switching annuity types. Option D is incorrect because the free look period does not guarantee returns. Question 22. What is the primary benefit of a death benefit rider on an annuity? A. Ensures the annuitant will always receive the same income amount during their lifetime. B. It allows the annuitant to designate beneficiaries who will receive a lump sum upon their death. C. It guarantees higher payouts for the annuitant if the stock market performs well. D. It protects the annuitant from losing their investment in case of a market downturn. Answer B. It allows the annuitant to designate beneficiaries who will receive a lump sum upon their death. Explanation: a death benefit rider allows the annuitant to designate beneficiaries who will receive the remaining annuity value or a lump sum payment upon the annuitant's death. This provides financial security for the annuitant's heirs. Option A is unrelated to the death benefit as it pertains to income guarantees. Options C and D are incorrect because they do not describe death benefits but refer to market-based annuities or investment options. Question 23. Which of the following would likely be a good candidate for a fixed indexed annuity? A. A person who desires high-risk investments and significant growth potential. B. A person who wants guaranteed returns based on a fixed interest rate. C. A person who wants protection against market downturns while participating in some market gains. D. A person who needs immediate and predictable income. Answer C. A person who wants protection against market downturns while participating in some market gains. Explanation: a fixed indexed annuity offers protection against market losses. The principal is not at risk while allowing the annuitant to earn returns based on a market index, such as the S&P 500. This type of annuity provides a balance between safety and growth potential. Option A describes someone who might prefer a variable annuity with higher risk and growth potential. Option B describes a fixed annuity, not an indexed one. Option D refers to an immediate annuity, which provides income right away, whereas a fixed indexed annuity generally has an accumulation phase. Question 24. Which of the following is a common feature of a variable annuity? A. The annuity guarantees a fixed rate of return for the life of the contract. B. The annuitant can choose from a range of investment options, including stocks and bonds. C. The annuity provides income payments that are fixed regardless of market performance. D. The annuity offers a death benefit that is equal to the original premium paid. Answer B. The annuitant can choose from a range of investment options, including stocks and bonds. Explanation: a variable annuity offers the annuitant a range of investment options, including stocks, bonds, and mutual funds. The returns are based on the performance of these underlying investments, which means that the value of the annuity can fluctuate. Option A is incorrect because variable annuities do not guarantee a fixed return. Option C describes a fixed annuity, not a variable annuity. Option D is incorrect because while variable annuities may offer death benefits, they are not guaranteed to equal the original premium. Question 25. Which of the following is true about an immediate annuity? A. It provides a lump sum payout at the time of purchase. B. It guarantees income for a fixed number of years. C. It provides income starting immediately after purchase, typically for life. D. It offers income payments that fluctuate based on the performance of the stock market. Answer C. It provides income starting immediately after purchase, typically for life. Explanation: an immediate annuity begins making income payments immediately after the annuity is purchased, often for the lifetime of the annuitant or a specified period. It does not offer a lump sum or investment flexibility like a variable annuity. Option A is incorrect because an immediate annuity provides periodic income, not a lump sum. Option B is more characteristic of a fixed period annuity, not an immediate annuity. Option D describes a variable annuity, not an immediate annuity. Question 26. What is the key characteristic of a fixed annuity? A. It provides income that varies based on the performance of the stock market. B. It guarantees a fixed interest rate and fixed payments for the life of the contract. C. It offers flexibility to invest in a range of stocks and bonds. D. It guarantees a lump sum payment upon the death of the annuitant. Answer B. It guarantees a fixed interest rate and fixed payments for the life of the contract. Explanation: a fixed annuity guarantees both a fixed interest rate and fixed income payments for the annuitant's lifetime or a specified period. This provides stability and predictability. Option A describes a variable annuity, which offers returns based on market performance. Option C is incorrect because fixed annuities do not allow investment in stocks or bonds. They offer a predetermined rate of return. Option D describes a death benefit feature which may be included in some annuities but is not the primary characteristic of a fixed annuity. Question 27. What does the term annuitization refer to? A. The process of converting a lump sum into a series of regular payments. B. The process of choosing investment options within an annuity. C. The process of withdrawing funds from an annuity before retirement. D. The process of adding riders to an annuity for extra benefits. Answer A. The process of converting a lump sum into a series of regular payments. Explanation: annuitization is the process of converting a lump sum of money into a stream of regular payments, which can be for a fixed period or for the annuitant's lifetime. This typically occurs after the accumulation phase of the annuity contract. Option B refers to choosing investment options within the annuity, which happens during the accumulation phase of a variable annuity. Option C describes an early withdrawal from an annuity, which may involve penalties. Option D refers to adding riders, not annuitization. Question 28. Which of the following is true about a qualified annuity? A. It is purchased with after-tax dollars and grows tax-deferred. B. It must be purchased through an employer-sponsored retirement plan. C. It provides income that is subject to taxes only when it is withdrawn. D. It is available only to individuals over the age of 65. Answer B. It must be purchased through an employer-sponsored retirement plan. Explanation: a qualified annuity is purchased with pre-tax dollars as part of a retirement plan such as an IRA or 401k, which means it grows tax-deferred. Once withdrawals are made, they are taxed as ordinary income. Option A refers to non-qualified annuities, which are purchased with after-tax dollars. Option C is partially correct for qualified annuities, but the correct option is B, as it specifically refers to annuities purchased through a qualified plan. Option D is not true. There is no age requirement for purchasing a qualified annuity. Question 29. Which of the following best describes a deferred annuity? A. An annuity that begins making income payments immediately after purchase. B. An annuity that guarantees a fixed payout for a set number of years. C. An annuity where income payments are delayed until a later date, often years after purchase. D. An annuity that provides income based on the stock market's performance. Answer C. An annuity where income payments are delayed until a later date, often years after purchase. Explanation: a deferred annuity allows the annuitant to defer income payments until a later date, often years after the annuity is purchased. The value of the annuity grows during the accumulation phase and payments begin in the future, typically during retirement. Option A describes an immediate annuity. Option B refers to a fixed period annuity, not necessarily a deferred one. Option D describes a variable annuity, which is based on market performance but does not indicate the deferral aspect. Question 30. What is the main benefit of a living benefits rider on an annuity? A. It allows the annuitant to withdraw funds at any time without penalty. B. It provides the annuitant with access to the death benefit while alive under certain conditions. C. It guarantees a fixed amount of income regardless of market performance. D. It allows the annuitant to invest in a variety of asset classes. Answer B. It provides the annuitant with access to the death benefit while alive under certain conditions. Explanation: a living benefits rider allows the annuitant to access certain death benefits while alive if specific conditions are met, such as long-term care needs or terminal illness. This feature provides flexibility and financial support during the annuitant's lifetime. Option A is incorrect because living benefits do not eliminate withdrawal penalties. Option C describes a fixed annuity but does not relate to living benefits. Option D is incorrect because living benefits do not relate to investment choices within the annuity.